Welcome to another edition of Brothers in Cars. I'm Rob Akins. I'm joined by my brother Fred Akins, and we have a special guest today, Steve Christensen, who's been in the auto business, he was just saying, for almost 30 years. And so, Steve, we brought you in today because we'd really love to know from somebody who's really got his boots on the ground, so to speak, about what's going on in the finance business when it comes to cars and what car buyers are facing these days. Now you're in California, so you've got a pretty high cost state that you're living in. Fred's also in California. I'm in Wisconsin. But Steve, tell us a little bit about your background in cars.
Okay. Well, thank you for having me. Let's see. Early 1996, a friend of mine who worked at a franchise auto dealer, new car dealer, in what's called the Special Finance Department, which is the sort of the lack of good credit department. Um, Him and I were talking, and I was looking to make a change in career path, and he thought I should give that a try. So I did. I left the radio sales business, outside sales position in radio, and tried that out. And turns out I liked it. So special finance is about just working with customers who don't have established credit or have generally bad credit, prior repossessions and what have you, and work with them, trying to get them into transportation that they both want and can afford. Um, and so I I got into the dealership business then and worked as a what's called a special finance manager for a couple of years, and then moved into traditional finance, which is then all ranges of credit, including leasing. So now we're talking about good credit, um, and did that for a bit and probably another year or two, and then became what's called a finance director for a large franchise dealer outside the Sacramento area. Finance director is responsible for working with your finance managers, of which I had three, and to make sure that all of the cars that are being sold that end up on a contract are actually able to get financed with area banks and credit unions and what have you, which is what I did. And in the heyday, pre 2008, we were selling between 300 and 500 cars a month. And so that's quite a lot of paper to move, all ranges of credit. And I did that up until 2010, made it through the '08 crisis, which was rather painful for the business. And the owners of the franchise dealer group that I worked for at the time um, also had an independent auto finance company called Elite Acceptance Corporation that they had formed but did nothing with. And we had spoken about it, and I'd mentioned that, I'd like an opportunity to see if I can make something of it. And so in early 2010, very beginning of 2010, they approached me and asked if I would take control of the company, which of course I did. Here I am 15 years later, and we do business in the deep subprime auto finance space primarily, in Northern California, but we had a field office in San Diego for a while. But we just stick to California, um, and we compete against companies that are routinely, I would say, 50 to 100 times bigger than us, frankly, because dealers don't care how big you are as a finance company. They only care about how effective your financing program is, and are you properly servicing the customers that we're lending to. Because in what's referred to as indirect auto finance, which is what we are, what that means is a customer can't come here to borrow money. They have to go to a dealership first. Direct auto financing is you walk into a bank or credit union, you apply for the loan yourself, and then they say, okay, you're qualified for $25,000, go out and find your car. Indirect auto finance is customer goes into the dealership agrees to sell them a car, and the dealership will submit the application to a list of lenders they work with, which in this case would be us. And we provide credit terms that are acceptable to us and hopefully to the customer and to the dealer. And we negotiate that transaction through the dealer. So strictly speaking, the dealer actually is our customer. The borrower is the borrower, but the dealer is our customer because that's where our business comes from. And so here we are in California dealing with something that, in my view, is significantly worse than what we saw in '08, and is lasting way longer than anybody expected. And we're having to get quite creative to survive. So that's pretty much where we are and what we're doing. Our challenges are a great many right now. And I'm sure that's what you want to talk about.
Yeah, well, thanks for that background, and absolutely, that's kind of where I'm hoping to go with this. Now, uh, did you mention? I'm sorry, I was fiddling with my laptop for just a second. I actually have the volume up so I can hear you better now. Uh,
Nice.
Now, your company portfolios their loans, meaning you're not trying to go out and securitize them or package them. You kind of eat your own cooking in that way.
It's a great point. It's funny you should say yeah, because pretty much everybody we compete with securitizes their portfolio, meaning, of course, sell it off. Um, we don't. So what I tell our staff here is that we have to be better at what we do than our competitors because we're stuck with it. We don't securitize annually or periodically, whatever others are doing, we do not do. So if we approve a loan for 60 months, our loans tend to time out for one reason or another. It's gotten a little bit longer, but it's just about 40 months. It used to be about 32 months. On average, a loan would come off the books via payoff, trade-in, insurance total, default, repossession, you name it, about 30-ish, 32 months. It's about 40 months now, they're a little bit longer. But since we do not sell any of our business, if we make bad decisions, we're stuck with it.
Right.
So that's a consequence of the type of business we're in, and it requires us to be a little bit more conscious about our decisions.
And I've seen that kind of elongation of the term in other kinds of credit. Part of that is because rates have gone up significantly
Right.
from where they were a few years ago. And also, in a lot of cases, it's harder. Either people are struggling more financially, so it's harder to get approved, or they're just not able to get out of their car as soon as they wanted to and buy another one or refinance it or what have you. So
Right.
that's not too surprising.
Well, I mean, okay, so consider that in the main throes of the pandemic, um, some the industry collectively decided, the auto manufacturing industry collectively decided. Um, there's different viewpoints on this, but um, that it was better to pull back on production and focus on profitability per unit. Um, so there was, one of the biggest franchise dealers we work with would routinely carry about 300 new cars in inventory or more, probably as many as 500 on the ground. Um, I've gotten into the habit of checking with them quite regularly about, hey, how many cars you guys got on the ground? And that number is 30 to 50. Um, and so if you're a consumer going in looking for a car, there's not many to choose from like there once was. And during the real peak of the pandemic, if you wanted one of these highly sought after, particularly like a hybrid, like a Toyota RAV4, I've seen those go for 10 to 15,000 over MSRP ongoing. And customers were walking in, check in hand, huge deposits, saying, yes, I'll take it. I don't care if it's 15,000 over MSRP. I want it. I don't know where that kind of thinking came from, but that was happening like crazy. And so as a result of that, we saw a massive inflation in Kelly wholesale Blue Book values. The wholesale market became massively inflated. Everybody saw it happening, and we knew it was not sustainable. So here we are financing a 2015 Hyundai Sonata that has a book value inflated a solid, say, 30%. And we're lending against this inflated value. within the back of our mind, knowing that the bottom's going to drop out of that eventually, and here we are, $18,000 in that car, only to find when the market drops that $18,000 loan balance against a $15,000 wholesale is now a $7,000 wholesale, and we're massively upside down as a finance company. The entire industry has faced this issue, and having to get creative to figure out how do you outrun that.
Right.
Can you originate enough business to compensate for being that far underwater in your collateral? And most people in this business have heard the term, outrun your losses. It's not really feasible. You can try to maintain some semblance of balance. I mean, a declining portfolio balance is bad in that no matter how good your decisions are, if your portfolio balance is shrinking, all of your ratios go haywire, your operating expenses look bad, everything looks bad. So you need to maintain a relative watermark or higher. Otherwise, your ratios don't look good. And if you're a securitized lender, you're going to have a problem because you don't look healthy. So you're going to start making decisions that are progressively worse to try to maintain balance, to maintain your ratios, and hope and pray and gamble that the portfolio improves over time. But enter California with the insurance industry and everything else that's going on. I no longer feel particularly optimistic that anybody's outrunning anything. I think it's a tidal wave of default that's headed our way. And we've been sandbagging for the last year plus in preparation for that. I've never seen lenders fail as fast as this. And a lot of the colleagues I've worked with for years, I've known through our finance association for years, have sold out, liquidated, and moved on, got out of the business. They no
Wow.
longer feel, yeah. I mean, it's I've seen it ones and twos over the years in 15 years, but it's a lot now. I've just given up. They do not see hope for the future, particularly in California.
So,
One thing
Fred,
I
I
was
wanted to bring you in a little bit because you've been on the manufacturer side. That's where a lot of your history was, as well as PR and marketing and advertising. But you spent a lot of time working actually for manufacturers or being very connected with them. And what Steve was mentioning before, the change in dealer behavior or how they manage inventory versus now versus pre-pandemic when we had it's not even the pandemic as much as it was the supply chain problems. And a lot of dealers kind of have changed their behavior. What are your insights about how it used to be versus how it is now?
Well, you're right. The pandemic completely upended the auto business. You had this huge supply disruption. Sales initially, when they closed down the economy, or most states closed down the economy, people stopped buying, and so manufacturers said, "That's it, stop building." And then they had supply disruptions as far as, it happened at the worst possible time because automakers were using more and more electronics, which are chipsets. And the places that made the chips weren't here in the States. The supply chain had been offshored to the point where they were coming from China, they were coming from Taiwan, they were coming from elsewhere, because the margins on new cars are so thin that most auto executives would kill their grandmother to save a couple of pennies per unit. And so you had this collision between what was out there and the supply, and then of course the costs started ballooning. And at one point, I remember, some of the big three, especially with pickup trucks, because after the initial shock of the pandemic, then of course the government started handing out checks. Well, people are stuck at home, but they've got this government check for a couple $1,000s, and it's like, well, what are we going to do with it? So you saw a lot of people put money into their homes because they were stuck there. But then you saw a lot of people put money into their vehicles because, well, I can't go to the mall, I can't go shopping, I can't go out to dinner, but I can go for a drive. And I can go for a drive by myself wearing my mask in my car, and all of a sudden, hey, let's do that. We need something to make us feel good. We're going to buy a new car. Well, of course, so you've shut down production, you've created this trough, and then the government starts handing out checks. The demand starts rebounding, pretty big. And now, you can't necessarily buy a particular vehicle. So you get these weird supply and demand disconnects where, for instance, Ford, to give one example, they had stockpiles of F-150s and Super Duties down in Kentucky, where they were parking them at unused racetracks and out in fields. And you could see all of these built but not quite finished trucks just sitting around waiting for a chipset, and the manufacturers started tinkering with, okay, what are we going to offer? Well, we're having trouble getting these chips that operate the heated steering wheel. So even though the product planners said, a truck at this level and above will come with a heated steering wheel, all of a sudden you get this line item on the Monroney label, the sticker, that says, well, it's supposed to have a heated steering wheel, but you don't get it. But here's a $50 credit.
Right. Yeah. My oldest son works at a Cadillac GMC Buick dealership here in Green Bay. And he ran into exactly that, where people, of course, going back to what we were mentioning about inventory, people were conditioned to walking onto a lot and having their choice of dozens, if not more, vehicles of a certain model to choose from. So the norm had become you would buy something that was in stock. And all of a sudden that went away because there just were no vehicles available. And so it went to, hey, well, you can order one. And so people started ordering cars, and they were willing to, and trucks, and they were willing to pay over sticker. And to your point about the chips, my son had a couple of customers who were buying Escalades or Denali's top end Denali pickups, and everything was done. He could see on the report everything was done, but they were waiting for something like the chipset that made the retractable running boards go in and out. And people were saying, "I don't care, just get me the truck, or get me the Escalade." But they wouldn't get shipped. So people were waiting 6 months, 9 months for something that had been built. It was showing on the report, built, not shipped.
Well, in my case, or in our case, we ordered a brand new F-150 in 2023. And I could track this. I could track it from the factory in Dearborn. I could track it to another factory where I think they were doing a couple of the accessories that we ordered, and then I could track it, you know, shipping by rail from Dearborn to Chicago. And we were back there at the time. We're waiting for this thing to come in. And we're there in Green Bay and we're waiting for it to come in. It's like, okay, where is it? And finally, we had someplace else to be, your daughter's wedding. And we said, we got to go. And so we finally said to the salesperson, as much as we want to wait for the truck that we ordered, can you find us something in the system that's close to what we ordered? And we'll take that. And that's what we wound up doing. So we didn't get the truck we ordered, even though it was built and down in Chicago. And I said, I'm happy to go down and pick it up. And they said, no, Mr. Akins, you can't do that.
No.
You know, I don't know if it was union rules or whatever, but Ford had to deliver it to the dealership in Green Bay. Because I even offered to fly to Detroit and pick it up at the factory.
Yep.
And drive it back to Green Bay. Because I don't mind driving.
So what a lot of dealers seem to have learned from that whole experience, and I'm coming back to you, Steve, is that they don't need to pay all that flooring to keep hundreds of vehicles on a lot. And if they create some scarcity, and this is my understanding, so correct me if I'm wrong here, but if they create some scarcity of available vehicles, people are a little bit less price sensitive and more, what can you get me? How soon can you get it for me? And yeah, I'm willing to pay a little bit more in order to get it. So is that kind of what you're still seeing on the new car side, Steve?
It's softening. I would say it's definitely softening from what it once was at its peak. The gross profit per unit seems to be coming down, so that's good. But supply still isn't there. And what I think has also happened as a result of this is that if you take your car into the dealer for service work, you're going to see a significant increase in labor rate from what you once saw. When retail sales volume on new cars and used cars, but cars drop like it did, dealerships in a fight to survive raise their labor rates, and so now as a byproduct of that, and this is one of those things where when labor rates increase, they don't really ever come back down. They stay high, and it's just the way it is. And so I think what's going on in addition to everything else is how many times as a consumer are you going to take your car into the dealer to get work done? Now keep in mind, and this is going to sound a little scathing, and I'm sorry for how this sounds, but service advisors at dealerships are salespeople. They are paid to sell service. Okay. So they're going to hit you up with everything. All right. And the labor rate is rather expensive. Yes. And so you're going to go to the dealership because you need an oil change and a tire rotation. But don't be surprised if you get hit with a requested or recommended repairs, $2,000, $3,000 in needed maintenance, on that car. And you're going to hear that, well, if you don't do this, your car may become unsafe to drive. And so you feel compelled to do these things. And so as a result, you start, what we've noticed is people are now afraid to take their car in for service because of the conflict that comes out of that equation. They don't want to do it. And so cars, by and large, aren't getting serviced like they need, it's creating a real problem for us on the finance company side because the condition of the cars we're repossessing are just deplorable. You should see these things. It's horrible. Used to be, on a typical, even an Altima sedan, whatever, Your transmission would fail. For $1,500, you could get it back on the road. We could repossess it. It's got a bad transmission, put 1,500 into it, get it back on the road, away we go, right? Figure three to $4,500, 3,000, 4,500 maybe. Transmission replacement cost. Any of these major mechanical issues are significantly more expensive than they once were, and so it's created a problem where um, you know customers don't have access to the new cars, like Fred was saying, like they once had. So they're buying older used cars and they're keeping them longer. And because of expenses to keep them on the road, they're not servicing them like they once did or should. And it's creating a lot of issues with, I know we've talked a bit before about a default rate, delinquencies on auto loans. Well, what's driving that? Because if you listen to the news and you look at what's going on, it sounds like the economy seems to be doing okay. Well, why is the automotive segment getting slaughtered so badly with delinquencies and losses then? Well, because it is so much more expensive now to fuel it, to service it, and to insure it than it ever once was, that comparatively speaking to other segments of the industry, automotive has taken it on the chin, I would say, harder than most, for those reasons. And, where does that end? When does insurance become affordable again? When does auto service become affordable again? I don't know that anybody can answer that. Back on what you were saying, Fred, about new cars. We, as an independent auto finance company, deal with independent dealers primarily. We do business with franchise dealers as well. But as a small company, if we were to do business with, Rob, your son's, Cadillac store, and we wanted to finance a new Escalade, we'd be looking at loan balances north of $80,000, let's say. In the new car franchise business, as an auto finance company, even if it's a Honda store, a Toyota store, pick any of them, we got to be prepared to be doing loan sizes significantly higher than we've ever seen, simply because of the costs of these cars. So much higher. Average monthly payments are $700, $800. We're seeing auto payments $1,000, $1,200, $1,400 for a Silverado diesel pickup truck, that kind of thing. We never saw payments like that before. So in order for us, due to economies of scale, we can't be writing loans that big.
Right.
Our average loan size is more like $15,000. That is a better number for us because it's not so many eggs in one basket, financially speaking. But consumers, by and large, they can't afford a $1,200 car payment. When you throw on top maintenance, fuel, and insurance, on top of the $1,200, they can't afford it. So an average loan balance, of 15,000, is probably going to get you a payment $450 to $500, depending on the terms, and at least that's a bit more affordable. But those cars are older with higher miles than we've ever seen for that equivalent loan size, and when something goes wrong with the car, I would say probably somewhere between, it ranges, but at least 30% of our monthly repossessions are because the customer gave up. They can't afford to fix it. They would keep the car if it ran, but they can't afford to maintain it. They can't afford to fix what's wrong with it, so they give it back. And this is significantly higher than we've ever seen. And I have no idea when that's ever going to come.
And that's something that, as a finance company, is really, really hard to predict. Is somebody, if they have a challenged or poor credit, payment history, whatever it is, they may have a good job and everything, but as you were mentioning before, especially in a state like California, where you have this truly, in my business as a wealth manager, you have what's called a bifurcated economy, where you've got a group of people who are very well off, doing very well, maybe retired, what have you, or just very highly compensated, and they can afford, they don't like the higher cost of living and the things that come along, the higher insurance costs and so forth, but they're able to kind of deal with it.
Right.
But then you've got a high percentage, and it used to just be maybe the bottom two quintiles, which is the bottom 40% of wage earners. But we've seen that creeping into the fourth quintile. So people who are like 75% on the income scale are now really struggling with day-to-day expenses. So if you've got somebody who has to make that decision, I can't fix the car, so it's of no use to me. So I'm not going to keep making the payments. I have to give it back, and then you run into that. And I brought up this screen share of 60-day delinquent auto loans, and the orange line here is subprime, which is kind of your
Right.
wheelhouse. But you also have prime. Now, when you say, oh, well, it's only 6.6%, that's still pretty low. Well, it's two things. Number one, it's that's a lot of loans if you look at all the
Well,
subprime loans.
it's not just that, Rob. It's not just the 6.6% that then leads to, downstream of that will be repossession. Is the average loss per repossession is now double what it once was.
Right.
So you can take that 6.6% and make it 12 then. I
Right.
mean, because it's if the loss severity were going down, then the delinquency can comfortably increase if you can control your severity, but the severity is out of control. It's
Right.
going down.
Especially, yeah, especially, I'm sorry to interrupt,
Not at all.
but especially if you are a lender, especially if you're in the mortgage business. I don't know if it's called a warehouse lender in your business, but back in the day, that's why so many mortgage companies disappeared in 2007, 2008, when they couldn't securitize their mortgages anymore because nobody wanted to buy mortgage paper. They had maxed out their credit lines. So
Yep.
they had no ability to write new mortgages because they couldn't unload what they had. And so if you're taking all these losses on top of that, that's a hardship. And then for somebody who portfolios their loans, keeps their loans, you've got ownership saying, "Hey, wait a minute, I'm not willing to."
They want to fund that.
Yeah, I don't want to keep funding that. So the approval gets tighter and tighter and tighter, and pretty soon the whole system starts seizing up.
Yes.
And the other thing I want to point out is sometimes people, when they look at certain things, as I've got on my other screen here, which I'm not sharing, but just overall consumer loan delinquency rates, and it looks similar, but on the auto loans, they're as high as they've ever been on record
Right.
from a percentage standpoint. And then, like you mentioned, it's almost leveraged up because of the per loan losses. But when you look at consumer loans, I get pushback sometimes when I'm talking about this. Well, on consumer loans, we're still not even at, we're barely at 3% of all consumer loans. And we reached a peak in the great financial crisis of about, 4.75 or something. So we're still about, 30%, 35% lower than we used to be. But it's the rate of change that is freaking me out more than the level. Because if we were slowly grinding up to 6.6% and it wasn't a sudden spike, that would be okay. Well, there's maybe something else going on. But when you've got this spike here going from about under 3% to 6.6 in the span of 4 years, that's scary. And it's the same thing with consumer loans. They've gone from less than 1.5% coming out of the pandemic to now almost 2.5%. And That's like a 70 or 80% increase in just the span of about 2.5, 3 years.
Right. Well, keep in mind also, consumers, especially here in California, just discretionary income just isn't there. Cost of living is out of control. I mean, go just a dozen eggs. Eggs have become the new toilet paper, by the way.
Yes, they have.
I mean, it was toilet paper during the pandemic. Now magically it's eggs. I mean, I've never thought what it costs to buy a dozen eggs is mind numbing. Nevertheless, costs to live here are unchecked, and so when you throw that on top of our average consumer here, your typical middle American is not going out and buying your $80,000 Escalade. They're looking for that $20,000 affordable used car is what they want. That's what they can afford. That fits their budget. Fine. Okay. Well, where do they come from? Because the manufacturers, Fred, this, manufacturers aren't building them. So where do they come from? Well, those are your lightly used prior daily rentals that Enterprise took to auction and sold or whatever. Your 3-year-old used car, that kind of thing. We're talking about the little Honda Civic leases and Honda Accord or Corolla leases, where you could go in and you could lease them for $100 a month, that kind of stuff. And those cars would get timed out and go to auction, and dealers would buy them up by the truckload and then sell them as used. Well, guess what? That's a healthy new car market feeds a healthy used car market. Well, there is no healthy new car market. It hasn't been for too long now. So as a byproduct of a lack of a healthy new car market in terms of volume, then there are no healthy used cars anymore. And so the used cars that are there now that are being bought and sold at auction, okay, which is where our dealers go to get their cars, okay, an independent dealer doesn't have a manufacturer to feed them. They have to go to the area auctions to buy them. And the cars that they're buying are older, more wore out. These aren't your prior daily rentals. These aren't your early term lease returns. These are cars that Fred Akins decided he didn't want anymore, and he traded it in and got something else. And that dealer took it to auction because they didn't want it, and they sold it to an independent auto dealer, which is our core market. Okay, that independent auto dealer, who is now struggling with a much lower volume that they once saw and much lower inventory levels than they ever thought they would see, are paying more for that used car than they thought that they should or think that they should. And as a byproduct of that, they're not reconning it like they should. It may need brakes. They might do that. If it's got legal tires, they're going to leave those alone. If power windows aren't working, whatever, just tell the customer, sorry, that doesn't work, whatever. They sell the car. They do as little as they can to make that car legal to sell. Okay. And here we are on our side of the industry who are just struggling to survive. Well, guess who's financing those cars? Well, there's us. So we're financing a lower grade of products than we ever thought we would. Okay. And the options are, well, okay, let's just not do that. Well, that basically means that we're no longer in business. So we have to then choose the best of the worst cars, okay, which are all bad, and finance them as effectively as we can, hoping to mitigate our loss. What this causes is we know, this scenario creates a lot of added risk. What we've proven, what we know for fact is you take somebody with good credit, they've had multiple paid auto loans in their past, they make reasonably good income, call it reasonably good income here, might be, a single wage earner at $5,500 a month. Fine. That's reasonably good income. Let's call it $5,500 a month. And you get them into an acceptable payment at $500 a month, plus insurance and the rest. Fine. So if you take the $500 payment plus $200 a month, $250 for insurance, depends on your driving record. Hopefully you're not a young male buying a Dodge Charger or something. It could be $300 or $400 a month. Well, let's just say it's $500 for the payment, you know, 250 for insurance. Now you're 750, you know, plus fuel, you're $1,000 a month against 5,500 in gross income, which take home maybe 3,500 to 4,000, depending. You know, you're broke. Okay. If that car breaks down, needs anything more than an oil change, our loan dies, period. Because if that car is taken to the shop, instead of $500 to get it back on the road, it could be 5,000. Okay. It is significantly more than it ever used to be. So what does this mean? Well, it used to be that we were really, really critical about what the credit report looks like. How many loans has Fred or Rob paid for in the past? Do you have good credit? Are you likely to pay? What's your credit history look like? That was the number one rule. Well, guess what? That rule isn't the number one rule anymore. We're having to look at the performance of that dealer. How likely did that dealer properly recondition the car? Do we trust them to do that properly? Number one. Secondly, what is the car? You know, we found that certain manufacturer cars have massive problems with powertrain issues. This is in part why, for instance, we won't finance a European car right now. If that car needs anything at all, you know, just move the decimal point, because it's going to be significantly more expensive than, you know, like a Toyota Corolla or a Camry or a Honda Civic or that type of thing. So we're focusing more on, are we dealing with the dealer who we know is operating a good business, who's properly reconditioning that car? And is that stable collateral that we can finance that car safely, knowing that, yes, I realize this customer's had spotty credit, but we understand why and what happened. And generally the story's the same. Well, you know, I bought this car from ABC Motors, you know, a year ago, and the transmission let go, and I couldn't afford to fix it. I would have kept paying for it if the transmission was good, but it wasn't. So there it goes. But I have a good job in income, and I got good down payment. And so we're like, all right, fine. You know, our interest rate as a result is significantly higher than we ever thought we were going to charge to try to compensate for the risk of this equation. But that's what we're doing to help manage that. But even through all of that, loss severity is still significantly higher than we like to see. The end game is anybody's guess. I don't know that anybody knows the answer to that question.
Well, if I may, to build on that a little bit, Steve, the other thing is that the entire car market has essentially turned itself on its head. When I was in product planning, about, let's say, 3/4 or so of the car market was actual cars. You know, your Corollas, your Camrys, etc. Now, the best-selling Toyota by far is a RAV4, a crossover.
Yeah.
Now, from a manufacturing standpoint, building a RAV4 isn't that much different than building a Corolla or a Camry. It's the same basic component set.
Right.
But you can charge a lot more money
for the RAV4.
For the RAV4, because people are willing to do that. The other thing I was going to say is, if you look at the car market, the pre-pandemic, the car market was 17 and a half, almost 18 million units a year.
Right.
And that was historically high.
Yeah. Then
the pandemic hit, and the market went to a little bit more than half. In the Great Recession, it did cut in half. You know, literally cut half the market out.
Thanks for watching part one of our interview with Steve Christensen about the current state of auto finance and the auto industry in general. This was such a good discussion that it went long, and so we decided, instead of posting just one really long video, we'd break it up into 2 parts. So be on the lookout for part 2 of our discussion, which should be posted in the next day or two. Thanks for watching.